Good morning, good afternoon, everybody. Thanks for joining. So we've got a little bit for those who are regular joiners of our webinars. We're doing something a little different. We haven't done in a while. We have a guest who's going to be presenting today along with myself, and that's John Bren from KBS, Investor and Advisor. And he's going to be talking about real estate investment trusts, or REITs for short. So welcome, John, and looking forward to this presentation. I'll get started first. So the first thing we have to put up for legal purposes is just to qualify this that Entrust is not advising or recommending or endorsing any particular investments. We are going to educate you about real estate investment trust through John, and then I'm going to talk a little bit about how to do it in a self-directed IRA. But that doesn't mean that we're saying you should or shouldn't invest in this type of investment. This is purely for educational purposes. Before you do any investments, we encourage you to seek out the advice of a CPA, a financial advisor, attorney, anybody like that before making any investment decisions. And do your due diligence on any investment that you're going to make. We're going to talk a little bit about Entrust, a real quick overview about Entrust, and then I'm going to pass the reins over to John, who's going to handle the next handful of bullet points, a little info about KBS, what exactly is a REIT, how to buy it through a broker, buying them directly, the mechanics, and then I'm going to take over at that point and talk about how you can invest in real estate investment trusts with a self-directed IRA, how you get started, and then at the end we'll do a Q&A. Feel free to, as you're going along, as your question comes up, go ahead and type it in the box down there, and then we're going to answer all the questions at the end. A little bit about Entrust. We have been in business now for almost 37 years, actually over 37 years. We probably need to update this slide. We do roughly 12,000 to 16,000 transactions every month, and we currently hold a little over $3.2 billion in investor assets. And what Entrust does is we provide the administrative and custodial services for self-directed retirement accounts. And a self-directed retirement account, for those who are new to this, is simply an IRA, 401k, also a health savings account or an educational savings account in which you make all the investment decisions and you can hold non-traditional assets. And a non-traditional asset is anything other than a publicly traded stock, bond, or mutual fund. So real estate investment trusts can be publicly traded. They can also be privately traded. And so we're going to be talking about REITs in general, but with Entrust, if it's a publicly traded REIT, then you don't need Entrust. You could do it with any traditional brokerage firm, but if it's privately traded or privately owned, then you would need a company like Entrust to do it in a self-directed IRA if you want to do it in an IRA. The majority of our staff are certified IRA service professionals, that's the CISP, and we focus on education. We're the only company in our space that has a national and continuing education program. We have 2 credit class for realtors. We have a 2 credit class for CPAs, and we have a class for CFPs. So if you fall into any of those and you're interested, we do them on an invitation basis. So if you're interested in having one of those classes, we'd be okay with coming in. We don't charge anything for it. It's just educational. It's called real estate. The one for real estate is called real estate IRAs. All right, John, at this point I'm going to pass the reins over to you. John Bren, everybody, is going to tell us about doing REITs.
Great. Well, thank you very much, Bill, and thank you for having me participate and contribute to your educational series. It's been great, and I just want to thank you and your team for helping organize. Basically, what we're going to talk about today is yield alternatives for IRA investors, and basically one of those yield alternatives are the REIT area and different types of REIT products. As we go into this, I'm just going to move forward here and talk a little bit about KBS. Just to give a quick little background, KBS was formed in 1992 by Chuck Schreiber on the left of the picture, Peter Bren on the right. I am, for full disclosure, just want everybody to know that I am the son of Peter Bren, the founder. So between Chuck and Peter, I've had a lot of exposure to real estate and real estate cycles, and that it goes back, as far back as the 70s. I hate to admit it, but it's true. But so the key thing I think about, from what I've learned from KBS and real estate exposure, from my family is how to survive, how to get through these different cycles and what it's meant. So KBS is running a little over $11 billion in AUM, about $37 billion in total transactional volume, and its investor base is basically sovereign wealth funds, institutional investors, pension funds, and also several non-traded REITs, which they're running now that are in different cycles. So that's the story in KBS. I will move on to the next thing, which is... Okay, so what I'm going to do in this part very quickly is that investors, whether it's through a self-directed IRA or in your regular brokerage account, there's yield alternatives that people can look for. So in your IRA, you're looking at different types of yield instruments for your yield bucket. You obviously have growth parts, you have stocks, you have other kinds of things, but really what we're going to focus on here today are different types of yield alternatives. So right now on this page, what we're going to focus on is just the yield curve very quickly, and then we'll move on. But basically, the U.S. government bond market, which would be considered the safest as far as credit, 10-year rates are 3% or slightly over, and that's assuming you hold it for the 10-year period and go through. U.S. corporate bonds, you're talking about A grade in about 3.9, investment grade going down a little bit at the lowest level of investment grade at the triple B's, 4.2. As you move into the high yield market, you can buy bonds and get kind of 5% in double B, and if you're going down to the triple C area, you can get 6.1%. There's also other kinds of utility stocks, ETFs, things like that, yield-oriented, that you can buy in the marketplace. Those range anywhere from 3 to 9% or above. And again, there's a reason that all those traded that way, but I just kind of want to show you what the alternatives are that you could be buying if you were just in your traditional brokerage account and doing that. On the next slide, we're going to talk about the different types of non-publicly traded longer-term holds, and this is really the area of interest for IRA investors looking for yield alternatives. I have been in this business, in the alternatives business, for over 30 years, and it wasn't until this January that I realized that you could invest through a self-directed IRA account into funds, into products and things that I wanted to invest in. I was never told that. My traditional brokers, advisors, people that I've had my IRA with in the past would only show me things that were available on their platform, and I didn't even know you could do this. So I really want to say, before I get into these different things, is how great Entrust has been to me as a personal investor on sorting all these things out. So I just want to say, when I first met with Entrust at the beginning of the year for my own account on how to do this, I mean, Nikita, JP, Gail, Caroline, Bill, they were so informative and the service was so good, and maybe I'm speaking too highly of Entrust here. I'm going to get them into trouble because I don't know if they serve me like they will serve all their other customers, but it was such a great educational introduction into this whole area and all the things I could do. I was so excited because now I could invest all these different kinds of sophisticated products in my IRA, and I immediately moved money over from my online brokerage account and set up an Entrust account. And I have to tell you, the Entrust people were great. It was done in 24 hours. I had money moved in, and everything was great. And then I started making investments, and the whole team was great. So moving down on the page, so there's lots of different types of what I would call private or non-traded investments, and that could range from REITs, credit funds, private equity, direct lending, and direct real estate investing. And each one of these things are longer-term hold, different types of risk profiles. We are going to focus, for the purpose of this conference today and seminar, really going to focus on the REIT world. But these are things that I look at, again, for my own IRA and different types of things. For people, there's basically two types of IRA investors from their self-directed accounts. There's the do-it-yourself, DIY investor who's doing the research on their own, and then there's people using their advisor to do that. There's lots of different allocations and buckets of things that have to be analyzed when you're looking at the different types of yield alternatives in the non-traded area for your IRA. So if you're a DIY person like myself and, in this business all the time and looking at all kinds of things, and I'm being pitched and shown all types of different investments, I do it. For most people, they need their advisor to help them because they have their normal daily activities, jobs, other types of things that they have to worry about, and they're not in it deep like I'm doing this all day long. So on the advisor side, what so many of the advisors I know that focus on the alternative area, they're doing the due diligence on the sponsors, on the products, and more importantly, deciding how much they should be allocating to different types of things. So the alternative bucket isn't just REITs, for instance. So you have to always, determine how much of your portfolio you're going to put into alternatives, how much is going to be focused on yield-oriented alternatives, and then you're going to need to decide, the different types of splits between that. I will say also that I wouldn't be here today if it wasn't for my go-to person on the advisor and RIA world, which is Jennifer Dorman Alpert from Real Asset Advisor magazine. She was actually the one that helped me and introduced me to Entrust and started this thing. So we're all one big happy family, and that's when when I need to find out about the advisor community and how they're doing their work and due diligence on the alternative universe. There's so many stories in Real Asset Advisors that profile the different types of advisors and the different types of due diligence that they do on all these products. So, alternative investment option for IRA investors: REITs, non-traded, and or private. So now we're going to focus on the REITs. Before I get into the key thing, which is the non-traded REITs and the longer-term hold, I want to do a quick thing on the publicly traded REITs. So people, a lot of times they ask me, what's the difference, John, between publicly traded REITs and non-traded REITs, and why would I ever go into a non-traded REIT when I can just buy something in my brokerage account on there? So the big positive to the publicly traded REITs are liquidity. You can buy them instantaneously and sell them instantaneously, and there's a marketplace for that. That's the good news. The bad news is that liquidity comes at a big price for people, and that means that basically because the fundamentals of the underlying real estate, the buildings, the malls, the apartment buildings, the homes, whatever it is in that publicly traded REIT, those things don't trade like a stock does, but the stock price moves all over the place based on people's expectations of interest rates, on recession, on anything that goes like that, and you get some change and the Fed says something one day and REITs can trade down massively. And what the other big problem is because of the liquidity factor, most publicly traded REITs trade at a discount to the actual net asset value, the NAV, of the underlying real estate. And so if you bought a REIT in the publicly traded market and you thought, okay, it has a nice yield on it, I'm going to do this, I'm going to hold, and it's going to pay for that. Well, if you're getting a 5, 6, 7, 8% yield, whatever that is, if the stock price has dropped 20% from where you bought it, you're never going to make that money back. And there's no way to close that gap. And I've also seen that people have said, oh, gee, this REIT is trading at a 20% discount to NAV. Isn't this great? And the yield is 14% based on the discount. Well, that's great up until the problem is when the gap widens from a 20% discount to a 40% discount or a 30% discount, and it's just very, very difficult to make that money back. The commissions charged to investors is pretty straightforward. If it's an online broker or something like that, it's pretty nominal on the commissions doing that. So the big risk with the publicly traded REITs is you have no control on the discount to NAV that these publicly traded REITs will trade at, and so to be exposed to that kind of volatility for having the liquidity or peace of mind that you could sell something the next day, it's a big risk that you have to be careful of. So let's move down to the non-traded REITs. So non-traded REITs are exactly what it means. It's either a publicly registered non-traded REIT, publicly registered with the SEC, or it's a private REIT where people just come in and they own shares or limited partnership interests in those funds, in those real estate funds and REITs. You have to remember that the underlying asset, whether it's office buildings, malls, retail, multifamily, homes, whatever it is, the hold on these are very long. This isn't something that you want to be holding for 1 year, 1 month, 2 years, things like that. So your time horizon needs to be much longer, which is why these are very interesting for the IRA investor. So if someone's saying I would like to have some yield instrument that's going to be great, but I need to pay for my child's education at college or something 3 years from now, these do not make sense for that. But for my IRA and for a portion of my IRA where I want to get higher yield and have this cash flow coming in and be able to accumulate that cash on a pre-tax basis in my IRA, these types of things make a lot of sense. Now, the key thing is on the non-traded REITs, when they're formed basically on the premise that people will go, put money into this entity, and then eventually the sponsor will go out and buy real estate or buy some real estate-oriented asset in there to get the revenue and the return. This is the key thing for people looking at REITs. The actual NAV versus the sales price NAV. That means that REITs are typically offered on some price that can either be stated arbitrarily. Someone could say, look, we're going to start the NAV at a $10 share price. And then there's there's REITs that have been in existence for a while, and the NAV is marked based on a third-party pricing service or group or accounting firm or something that does that and prices the entire real estate value of the REITs minus the expenses and lending against that, and then they come up with an actual NAV, and that is then struck doing that. So brand new REITs trade at a price where they've just made it up to raise the money and have that start, and then there's seasoned REITs that are in place where the NAV is much closer to the real value underlying. The other thing in the non-traded REIT, which has changed a lot because of some rule changes with the government and the DOL rule, is that some non-traded REIT sponsors and people are going to direct access, and this is really key. This is a new strategy, and a few people are starting to make that move toward that, KBS being one of them, and that's really the direct access, direct consumer investor to the REIT and to the real estate itself, and bypassing the traditional brokerage channel on how these things were sold, and we'll talk about that in a minute. But that's really the big, exciting new thing in the non-traded REIT area is the direct access and the few sponsors that are offering that. So buying REITs through brokers. So this is how it used to be done in the past. REITs were always purchased through a broker, advisor, hybrid RIA, however you want to characterize it. But publicly traded REITs are bought through your normal broker, or you can do it online. It's low commissions, things like that. The non-traded REITs were sold through brokers, and they would be charging higher commissions, and that were either baked into the NAV or somehow set up in the accounts. And those commissions could have been quite high. They were quite high. And now with going from the commission model to the direct model, the end investor is getting a lot more return from the real estate and from the cash flow by bypassing these large entry-level commissions in doing that. So this is a huge move in favor of the REIT buyer, and the key thing is the direct access, as I mentioned. So what are some of the key sponsors that are doing this? They have basically a couple of different ways for investors to purchase and do this. You can do it through your online portal and website of the sponsor, or you do it through your self-directed IRA custodian, but into dealing with the sponsor. And so, for instance, it was easy for me to go directly from Entrust and buy the different types of REIT products and instruments and funds that I want to do for my IRA. I would just do it directly, get the subscription documents from the sponsor, whomever that might be, and then I would fill out the forms, do that, get the direction letter to Entrust, and they would make the investments for me. I wasn't paying any commissions. I was going into different types of products where there were just no entry-level commissions doing that because I was doing it myself. Or if I was using an advisor, I'm paying that advisor to do that and just going straightforward. So that's again, that's just the different ways are through the online portals and either through your self-directed IRA custodian. So the key thing are the commissions coming in and out, and whether you're paying and what you're paying for, and it's so important to understand for the DIY investor, and if you're using advisor, to understand what the costs are to enter these non-traded REITs and get that, because when you're dealing with yields, that are, in the high single digits, mid single digits yield with some potential upside if you were paying, several points in commissions, you're going to eat up your yield in the first 2 years just in commission costs. So that's different. So transparency is really, really important. Sponsors are taking a more open approach to people. I know that KBS really prides itself on total 100% transparency. Everybody can see everything down into the REIT, from buildings, tenants, exposure, markets, everything that goes involved. It's all there and all very easy for people to access directly. So REITs are not all created equal. And if I can leave anybody with anything, the most important thing is don't yield shop. What that means is don't be romanced into seeing something that says, oh, this has a 15% IRR target or a 22% IRR target, or this thing yields 9% or 10%. Because go back to that yield curve that I was talking about earlier. There is no free lunch. And so if you see something that has a 15, a 12, an 18 IRR return profile, the risk to that is enormous. And I can just tell you this from one thing. Of all the top real estate sponsors, let's just take the people in the office building area, and I won't mention the names, but let's just say, KBS being in the top 7. If you take the top 7 commercial office real estate managers in the country, nobody's that smarter than the next guy. Meaning, we're not going to be able to, I'm sitting here in the IBM building here in New York City. I mean, no one's going to be able to buy the IBM building better or worse by a factor of 500 basis points or more to get a better yield. So it's just really be careful on the risk reward that you're taking. First thing to look at, what is the quality of the real estate? Is it an A-class building? Is it a B building that needs a lot of work? Is it a multifamily development in the outskirts of Dallas where there's 19 cranes within 20 blocks of each other building the same kind of thing? So the yields on those things can be very different and the risk can be very different. So it's key to understand quality of the underlying real estate. The leverage of the REIT itself, too, is really important. And also, is the middle one there is the diversification of the regions. Again, if you're if you're in a multifamily REIT that's doing apartment buildings, and the exposure right now is downtown LA and Dallas and some other places, I mean, there's a lot of competition in those markets, and you just don't know where things are going to be in 3 years. The other thing, too, is that people will gross up their leverage, meaning they will increase the leverage of the REIT or the underlying buildings to get a higher yield to enhance or entice people to come in and purchase because they say, oh, well, this has a 10% yield or a 9% yield. And I can just tell you, there are no free lunches out there. It is no 10% yield with nominal risk. I can just tell you that in seeing hundreds of different types of products myself and what I've been shown. So liquidity, this is really key, and the redemptions, because what's happened is REIT sponsors and the wholesaling networks to sort of move and try to entice investors to participate. People are coming up with different sort of formats, structures, things like that. Daily NAV REITs, liquidity REITs, things like that. And I can just tell you that all you have to do is look at the underlying. If you buy an office building and you're going to hold this thing for 7 years or 5 years or whatever amount of time you're going to hold that office building and manage it, add value, lease it up, and do things like that, there is zero liquidity in that building if you need redemptions. So if someone says, okay, we have a liquid REIT and it's a daily NAV REIT, and in the prospectus it says you can sell and tender your shares in for redemption, and some have a redemption haircut of, let's say, 5% or something. But if you're in year 3 and you want to liquidate your shares in a REIT, and even though the private placement memorandum says you can tender those shares, two things, there's only 3 ways liquidity can be given to you. 1, the buildings have to be sold, which isn't going to happen, or very unlikely in the first few years. Number 2 is you have to increase your leverage. So the sponsor would have to borrow money at the REIT level, which also has tax consequences we'll get to in a minute, but they could borrow money or have a standing, side thing with a bank where they could have a line of credit to pay out redemptions and do that, but that's just increasing leverage to the existing shareholders, which isn't fair in my opinion. And then the third one is you have to go out and do a capital raise or money raise to have new people come in to pay out people that are exiting. There's a lot of names for that. I'm not going to go into that now. But the key thing is understanding your liquidity redemptions. The other thing, too, is if there was a crisis or a run on the bank and the private placement memorandum says, oh, you can tender your shares at this and that, it's very easy for the board of directors to stop that redemption period. So, again, I warn people to not get romanced by things called daily NAV REITs or liquidity terms or things like that without really understanding that the underlying asset is not a liquid asset and you should be in this for the longer term and do that. And I know I'm being a reverse salesman here for REITs, but it's so important that people have their liquidity terms aligned with what their investment objectives are. Otherwise, there's going to be a lot of disappointment. And then the last part of this on the REIT mechanics is how is the NAV of the REIT calculated? When I see someone say they have a daily NAV REIT, well, the real estate isn't being priced daily. It's not being priced monthly. It's not being priced quarterly. So it's, what does that really mean? That's, depending on the instrument and what's being offered, that's what really needs to be focused on, or how are those NAVs being calculated. Okay, last slide here on real estate. Where are we investing now? I've been in multiple meetings with Chuck Schreiber, CEO of KBS, and I'm going to steal his response on this, but we've been in multiple meetings with institutional investors, family offices, friends of mine that are very, very sophisticated investors. They always say, Chuck or Peter, what inning are we in real estate? And Chuck always responds, well, before that, could you please tell me the weather in the United States? And so that's when people say, where are we, what inning are we in for real estate, it means it's just way too broad of a term. So at KBS, I know that everything could focus down to what corner are you on and what city. Are you mid-block? Is it a B-plus building? Is it near a BART station in San Jose? Or is it near something in Portland where people can get off of a light rail or things like that? I mean, all of that has to do to the specific city, the specific block, and the specific type of building or underlying asset of real estate that you're dealing with. So cycle, it's very, very difficult. I can just tell you that the downtown LA multifamily apartment with all those cranes going up, that is going to be a different cycle than another city that doesn't have that kind of growth and movement of new product coming onto the market. So let's just talk briefly here because of the KBS expertise and history in the office market. So basically, a lot of people always say, well, what cycle are we in the office market? And basically, we've talked about specific regions, specific towns, and specific part within the city to do that. But the key thing is since the 2008 crash, in the financial crisis, the amount of lending from banks to commercial office developers is dried up's not the right word, but it is significantly lower than it was pre-crisis and what it was like in the 90s and in the mid-2000s. So what that's done is that's kept a cap on new supply and new development of office buildings. So you see a lot of cranes in the air that are building apartment buildings, but there's not a bunch of cranes in the air building new, 50, 60, 70-story office towers in various cities and going through. So there is a limited new supply, which is great for the people, like the firms like KBS, things like that, where they're looking at buildings that could be, whether either there's value add that can be done, or they can take a core plus asset, high quality, and make it a better building in the right town, things like that. Inflation. We have had a little bit of pickup in inflation. That's partially because of the economic growth and what's going on now in the last sort of year and a half, 2 years. That's going. I think there's more of a positive outlook. And the other thing too is that in the office market, where people thought that there was going to be this sort of move to the suburbs and people were going to sort of telecommute from either regional office in the suburbs. Now, the younger millennial class of workers, things like that, they want to be more in the urban centers, in the buildings, and they want to have a much more efficient work environment, and they want to be able to collaborate, which is really key. So as far as the office market goes, are there great steals out there? Clearly not, because there's too many sophisticated people out there with a lot of money and a lot of dry powder to do that, and you don't have this huge overhang of leverage. So the office market, again, it's going to come down to a deal-by-deal group, and it's going to come down to the sponsor and who is the experienced person that can not only purchase, because there's a lot of financial buyers of real estate, but the most important thing are the sponsors that have the operational history of doing that. Obviously, KBS and doing this for over 26 years from an operating standpoint and operating, millions and millions of square feet of real estate. So I will end it there, Bill. And again, I just want to thank Entrust for having me be here. I'm happy to answer any questions that people have. And again, thank Entrust for including me in your educational seminar.
All right, John, thanks. Yeah, and again, John's going to stick around and answer questions, as I will. It's only a couple minutes left to the presentation, so if you do have questions, go ahead and start typing them in, and we'll get to those at the end. So I'm just going to do a quick case study on if you want to invest in REIT and you want to do it with a self-directed IRA, again, which would be a private REIT, then you would need to have a self-directed account as opposed to a publicly traded one that can be done with any brokerage firm. So first of all, you establish an Entrust account. And so then if you're going to invest, then the name of the entity investing would be the Entrust Group for benefit of, that's what FBO, your name, and then your Entrust account number. When you're using your retirement account as an investor, that is the wording, that is the name of the account that we'll be investing. So in this case, Alan Wood is going to be the investor. He's going to buy a REIT. So he rolls over from an old 401k. He used to work for a company, left the company, he's got that 401k. Since he's no longer with the company, he's eligible to roll it over into an IRA. And so rolls it over to Entrust and identifies investment that he wants to make. So it's up to Alan, it's up to you as the investor to do any research and due diligence on the investment that you want to do. So that includes all of these steps. Review and analyze any written material. As John was mentioning, look at the underlying assets of the REIT and the quality of those assets. Any leverage that's used to acquire the assets. Reviews the private placement memorandum and subscription agreement. Ask a lot of questions. Speak with the sponsor. And then ensure that the transaction does not involve any disqualified person. So when you're using your retirement account to invest in an asset, there are things that are called prohibited transactions. A prohibited transaction typically involves a disqualified person. And I'm going to give you an example that's outside the REIT scenario, but for example, you can't use your IRA to buy a property that you yourself are going to stay in. So you can't be a second home or a vacation home. You as the account holder, your spouse, your ancestors, your lineal descendants are all considered disqualified persons. So there's a potential when talking about a REIT, not necessarily with the property, that's probably unlikely, but from a standpoint of, like, for example, if John probably has there are some limitations on him being able to use his IRA to invest directly into a REIT that is held by his company because of how he is compensated by that company. So that's just an example of a way potentially that it could be a prohibited transaction that involves a disqualified person. So Alan does his work, decides that it fits into his retirement strategy, provides the investment documentation and trust. So with a REIT, it would typically be a subscription agreement. Again, the subscription agreement in the name of the IRA as the investor, the Entrust Group for benefit of FBO, account holder's name and account number. So he completes our form called a bidirection letter. and a private placement disclaimer and indemnity agreement, submits that to us with a subscription agreement. He marks that as read and approved. We sign the agreement on behalf of the IRA. Again, the IRA is the entity that's doing the investment, so we have to review and sign off on that document, and then we send the money to the broker, and now the purchase is complete, and now Alan can log into his account and see that that investment, that REIT, is being held inside the retirement account. Process is very straightforward. Open an account, which can be done 10 minutes through our website. Go to theentrustgroup.com. Up at the top, you'll see a little button there that says Open an Account. Just click on that. You're going to enter in your name, address, social security number, upload an ID, answer a few questions, select your fee options, and boom, your account is open. Wouldn't take any more than 10 minutes. You fund your account, which is either done by transferring from an existing IRA, rolling over from a 401k, 403b, or some other qualified plan, or making an annual contribution. And an annual contribution, there are limitations depending upon what your earned income is, the type of account that you have, on how much you can contribute on an annual basis. And then step 3, purchase your asset, which is done by instructing Entrust to purchase the asset through the IRA. And we have forms for that called a bi-direction letter, and then we need the supporting documents for the investment. So whether it's a REIT or property directly, we would need the purchase contract for the property and other closing documents in the name of the IRA. If you're doing a loan, we need the promissory note with the name of the IRA as the lender. But it's those steps: open an account, fund an account, purchase the investment. As I mentioned, you can open an account in about 10 minutes. Go to theentrustgroup.com. You can type that right in, or just stop at the slash, and then you'll see Open an Account as one of the buttons. You can click on that. We'll get some in, like any bank account, any account that you open, name, address, social security number, some other information, a copy of your ID. We have a new account establishment fee of $50. You provide a credit card to pay that, and you can pay any other fees by credit card or debiting from the account. Okay, that's it. So John and I are going to answer some questions for you. I'm going to put up our contact information, so if you want to reach out to either one of us directly. And I'm actually going to start it off with a question for you, John, that I have. So with, is there typically a difference in the underlying investments between a publicly traded REIT and a private REIT? Like, is there, public REITs invest more in maybe real estate companies, or is there often a difference in terms of the investments that are being made between publicly traded REITs versus private REITs?
No. In other words, there are office REITs that are publicly traded, there's mall REITs that are publicly traded, and there's private REITs that are investing in office buildings, and there's private REITs that are investing in, mall properties or medical facilities or things like that. So both instruments can be, both non-traded and traded, publicly traded, can own the same types of instruments or same type of buildings.
Yeah. Okay. All right. Thanks. All right. So I'm going to read the questions, and then John and I will get to the answers. So the first question, which is for you, John, what is the minimum dollar investment for a REIT?
Well, that, again, I can't speak specifically on this to the KBS REITs, because it's a little different. I have to be careful on this call. I'm happy to answer that. But the minimums are really set by the REIT sponsor and what they want to do. There's no statutory minimum to do that. So you could have investment sizes of $5,000 or $50,000, or $100,000 minimums, things like that. So it really depends. I would just say that for someone that is going to make an investment from their self-directed IRA, just given if you're doing it for a yield, then you want to make it at least significant so that it's worthwhile from an expense standpoint to get that yield and keep as much of it as possible.
Okay, next question. What kind of IRAs can I transfer to a self-directed IRA? Roth 401k, or traditional 401k only? No, all of those. So the term self-directed IRA is just the self-directed aspect of it. It's an industry term that means that you make all your own investment decisions and you can hold non-traditional assets. So any type of retirement account can be self-directed. You can self-direct a traditional, you can self-direct a Roth, you can self-direct a SEP, you can self-direct a 401k, and we also provide a health savings account, educational savings account. So any type of retirement account can be self-directed. Next question, can we also roll over dollars from an existing company's 401k to a self-directed IRA? If the question you're asking me is, can you roll over money from a 401k for a company that you are currently working for, it depends upon the plan for the company that you're currently working for. Some plans allow it, some plans do not. Most do not. But some allow it. It's called an in-service withdrawal or in-service distribution. So if the plan allows for, if you're working for a company and the plan allows for an in-service withdrawal or in-service distribution, you are allowed to roll over that money. But there is rules around how much. You still wouldn't be able to roll over the entire amount. You would have to talk to your plan provider or talk to your benefits coordinator with your company. The most 401k plans to roll over while you're still working for the company requires a qualifying event. The most typical qualifying event is that you leave the company, but sometimes they might have an age-related qualifying event. So if you hit a certain age, you can roll over at that point. So my suggestion, if you're talking about a company that you're currently working for, talk to your plan provider or to your benefits administrator for your company to see if you can roll over. It's something you want to do. If it's an old 401k that you, excuse me, an old 401k with a company you no longer work for, then yes, you absolutely can roll that over. Next question. The common theme is that REs, real estate, I'm guessing that's REITs, irrespective of the class in a bubble. So why are you pitching REIT as an investment at this point? All right, so I'm going to say one thing. We are not pitching REITs as an investment. We are educating people on what a REIT is and how you can invest in that inside a retirement account if you want to. So, you know, let's just clarify. There was no pitch that was done here. John, I don't know if you have anything you want to add on that. Again, the question is, the common theme is that real estate, irrespective of the class, is in a bubble. So why are you pitching REIT as an investment at this point?
Well, again, I think the hard part would be determining what is a bubble and what does that really mean. So if you own a building that's 100% leased in Houston, Texas, with a AA client, and you have slightly over 2-to-1 leverage, so let's just call it 55% loan to value, is that building in a bubble? I mean, I don't think so. So, and it's cash flowing, and you have a cash-on-cash return of over 10%. I mean, so again, it really comes down to the underlying asset. And I just go back to Chuck Schreiber's line of, you know, how's the weather in America? So to say that real estate's in a bubble could mean anything. So, you know, is there a bubble in apartment building in downtown LA or parts of Dallas, Texas? Yeah, maybe. I don't know. But that really comes down to the people doing the specific due diligence on the underlying assets that are being purchased in that REIT to understand what your risk is. And that got back to my sort of original slides on understand the underlying and the risk you're taking, because that's the key thing. But I would disagree that real estate's in a bubble, because it's just too much of a generic, general term to do that. So that's my view.
And I will add, at least when it comes to retirement accounts, I mean, usually the expectation for most people inside the retirement account is they're going to invest it in something. So if you think real estate is not a good investment, don't make real estate as an investment. Again, we're not pitching that you should invest in real estate or not. It's just an investment option that you're allowed to do inside a retirement account. And as much as anything, that's what we're promoting, is the idea, the knowledge that it isn't just limited to stocks, bonds, mutual funds inside a retirement account. You can hold other assets. If REIT is something you're interested in, and a private REIT in particular, that's an asset you're allowed to hold inside a retirement account. And that's what we're trying to focus on, is just here's how it works, here's what you should know, and then in this case, if you're considering a REIT, here's some questions to ask, here's some things to know about it. Next question says, this sounds just like a TIC, tenant in common. Other than funds to purchase the REIT, what are the differences such as taxes, etc.?
I guess within the IRA, that would probably be more your side, Bill. Just,
yeah,
again,
I mean,
I think there's advantages. Yeah, sorry, go ahead.
Yeah, I mean, it's true that inside a retirement account there are no maybe they're asking about property taxes. I'm not really entirely sure about that question either. But I mean, inside a retirement account, whether you invest directly in real estate through a TIC or you do it to purchase a REIT, inside the retirement account, any revenue generated by it goes directly back to the retirement account. So there are no tax consequences associated with that until you take the money out as a distribution. Other than funds to purchase, what are the differences such as taxes? I don't know if they're talking about property taxes or anything like that. I don't know if you have anything else you want to add to that, John.
I don't. Sorry.
Okay. Next question, is there a minimum investment amount to open an account with a custodian? Well, with Entrust we don't have a minimum amount, no. Some other custodians do, but Entrust does not. Next question, if I invest my self-directed dollars into a NTR, how long does it have to stay there? If I want to move it to a different REIT, can I do that? You are not required to hold an investment inside your retirement account for any particular amount of time. It's entirely up to you. If you buy something and want to turn around and flip it the next day, that's entirely up to you. There are no requirements to hold any investment that you do inside a retirement account for any particular amount of time. Next question is, can a trust be a disqualified person? And the answer to that is well, so if you name, if you are the beneficiary of a trust, or if you have let me put it this way, if you name your trust as a beneficiary and there's an individual named in that trust who is named as a beneficiary of the trust, then that person is a disqualified person to your IRA. Okay, so I don't know that a trust as an entity can be a disqualified person. I think we'd have to have a conversation about that and tell me like how you're planning on using that trust and whether that creates a prohibited transaction. But a beneficiary named in a trust in which the trust is the beneficiary of your IRA would most certainly be a disqualified person to your IRA. David, I hope that answered your question. If not, you can maybe expand on it there, or you see my email or phone number, reach out to me directly and we can talk about it. Next question. On a different note, can a REIT be formed in lieu of an LLC in order to invest in residential rental properties? Can my Roth IRA then be an investor in that REIT?
That's your jurisdiction,
Bill. If I
Bill.
can answer that or if you can. I mean,
that's you.
Can a REIT be formed in lieu of an LLC? I mean, I don't know what's involved in forming a REIT. Is a REIT set up as an LLC typically, John?
No, the REIT is set up as a corporation or as a company. Because of that structure, it's also required to pay out 90% minimum of its income flows out to its investors. That's how it keeps its tax flow-through status.
I mean, I guess, James, if you're asking, can you establish your own private REIT and then use that REIT to bring in investors and use your IRA to be an investor in that REIT and bring in potentially other investors or not? I mean, I guess as long as you meet any of the SEC requirements that's associated with something being considered a REIT or qualified as a REIT and meet all the laws and regulations associated with that, then sure, I don't see why you wouldn't be able to establish it as a REIT. But I don't know what the requirements are to meet those qualifications as a REIT as opposed to an LLC. Next question: are there any reputable REIT managers that specialize in global international real estate investments?
I can't answer that only because I'm not allowed to. I mean, I know people and very reputable stuff, but I can't be promoting anybody else nor ourselves.
So, John, who asked that question, I would suggest that you reach out to Bren directly. I think it sounds to me like it was a yes or no question. Are there any reputable REIT managers that specialize in global international real estate investments? I would say the answer to that is yes.
Yes,
right?
The answer is yes.
Okay. REITs tend to have favorable tax advantages. How are taxes, cost basis, and dividends handled? This is obviously would not be inside a retirement account. I'll repeat the question for John. REITs tend to have favorable tax advantages. How are taxes, cost basis, and dividends handled?
Well, the key thing is you have two types of distributions that are made by the REIT. That can either be income or capital repatriation or capital distribution out. What happens is at the end of the year, if this is outside of your IRA account and you're getting it, like I'm an investor in various REITs, I get a 1099 at the end of the year, and that 1099 tax statement is split between what would be interest income coming from cash flow and then distribution from valuations of the property or things that are being sold. So it's better. It's a better tax position than you would be. It's just if you owned a bond and it's just all ordinary income coming from you, so that tax advantage of that income stream is better than a typical yield instrument in the publicly traded markets. But that split is going to determine, based on the property, how much of it's leveraged, and it's specific to the property and to the REIT sponsor, but it is going to be better than just owning a straight out bond, is from a tax perspective.
Okay, next question. Do we have info on contribution? How much we can contribute based on my income, my current plans? I mean, we have information on our website. That's easily can be Googled. I mean, that's standard IRS information on how much you can contribute, depending upon the retirement account, depending upon your income. So I would encourage you to either go to our website, or that information is publicly available really easily to find out. But if you want, you can send me an email and ask for a summary document that has all the different types of retirement accounts and the contribution limits in like a one-page document. So if you want that emailed, send me an email, or just at the end of this, you're going to get an opportunity to provide feedback, and just mention that you want that sent to you. Next question, how much does the Entrust Group charge? Our fees are available on our website, or as just answered the previous one, you can email me or leave that as a message have somebody send you our fee disclosure form. We have we potentially have different fees for things like precious metals versus traditional investing in private equity or real estate or something like that. So if you might want to specify specifically what you're looking to invest in. A broker-dealer provides a level of assurance to individual investors because of the due diligence they do. How can an individual investor going direct to sponsor be expected to conduct the same level of due diligence himself when that's not his profession? I don't really have an answer to that question. I mean, if you're not comfortable doing your own due diligence, then I would suggest that a self-directed account and alternative assets is not for you. There are certainly, I will add one thing. I had a brief career working for a large brokerage firm, like a company that you would recognize as somebody that people that recommend that you open an account with them, and they'll do all kinds of research and make sure that you're well invested. And I can't say that I was trained all that well and knew all that much more than an average person. So your expectation that they do this extreme level of due diligence, what they do is they get courted by different fund companies that ask them to sell to promote their funds. And those companies, the big brokerage firms, Fidelity, Charles Schwab's, et cetera, of the world, and I'm sure some of the broker-dealers are better than others, but ultimately those companies are instructing their broker-dealers to sell the funds that the companies are selling, that are getting them and paying them a commission to sell. That's all I'm going to add on that.
And I'll just add one thing, Bill. Oh, sorry, go ahead.
No, I was reading the next question. Go ahead if you want to add on to that.
No, the thing I was going to add on is being on the other side of the table at the sponsor side. So I see what different broker-dealers and different advisors do from a due diligence perspective, and there's a huge gap between certain types of advisors and certain types of broker-dealers that are doing the due diligence. I see the questions that are being asked. I see the depth of their knowledge in being able to do that, and that's why it's really important to understand who the advisor is that's helping you do this. And that's why, again, dealing with some of these other advisors and the people I've met through Real Asset Advisors, I mean, you have some very, very sophisticated advisors that are doing significant due diligence on everything down to, I mean, I'm talking about buildings in Portland and Houston and, Orange County and things like that. And then I have other people who just say, hey, what's the yield and how much are you paying in commission? And so there's a huge spread between that type of advisor or that type of broker. So it's a big win. And so again, I hate to put it back on the investor at the end of the day, but if the investor can do the work and there's enough transparency to do it, then that's great. If they don't have the time and they have other parts in their life to do that, then you go to an advisor, but you use an advisor that really understands the alternative universe and not just one part of it. And that's where a lot of advisors are separating themselves now on their knowledge and expertise within the alternative investment area.
Yeah, and I mean, when we say you need to do your own due diligence, what we're saying by that is Entrust isn't doing any of the due diligence. That due diligence doesn't have to be you as an individual. You can have an advisor in your life. It's just not going to be Entrust. We're not doing any due diligence on the investments. It's self-directed. But, I mean, if you have people in your life who know stuff, then use them. Okay, next question. Can these private REITs be purchased in a non-IRA account also, and how can one participate in KBS REIT with non-IRA funds?
So that's easy. The answer is yes, you can. You can own it for cash, as I do. I have positions in the KBS REITs and other investments directly in my normal, what I consider my investment account or my cash account outside of my IRA. To participate directly into a the KBS REIT, to do it directly as we've done that, we have the website and portal to do that exactly. I mean, KBS Direct. People can come and they can get all the information they want. They can subscribe and or do it through their Entrust IRA and come right in the same way. So we're set up to do that with both the IRA side or directly from the cash side. Very simple, very seamless, no commissions to the investors.
Okay. Are there REITs in sectors? Are there REITs in sectors? Question. Residential? Question. Office? Question. I want to stay away from malls, etc., which was capitalized. So he really wants to stay away from malls. All right, Jonathan, go ahead. That's for you.
The answer is yes. There's lots of sector REITs. Most of them are based on a specific class or type of real estate. So there are mall REITs. There are high-grade office building REITs. There are more value-add REITs, higher risk. There's apartment, there's REITs that specialize in medical office buildings, and there's things that are just for, suburban office in the Arlington area, because of all the businesses that are coming out of D.C. and things like that. So they're very specific, and again, no REITs are not created equal. They all have different risk. They all have different regional exposures, and they have different types of exposure to different types of underlying assets, like I said, office buildings, multifamily, residential, things like that. So yes, you want to stay away from malls. There's plenty of options away. You're not stuck owning a piece of a mall because you're in some, KBS, our REITs are all office.
Okay, and then the same person followed up, are there REITs that you can buy into on a regular basis over time?
Yes. There are REITs that both the publicly traded, but on the non-traded REITs, as long as the offering is open and you know and understand the NAV price that you're purchasing that REIT at, yes, you can. It's not a one-time. It's open and then closed. They're constantly open for several years as they're raising the capital to do that, and they're deploying the capital to buy assets. Okay,
next question. How different is private placement REIT with KBS different from investing through crowdfunding websites?
Okay, so it is different. Okay, so when you're buying a KBS REIT through the KBS website portal, you're buying the specific REIT. You can do all the due diligence on the REIT, see the buildings, and do all those kind of things. Crowdfunding is more of a fundraising platform, and people will go out and say, okay, we're going to put on a crowdfunding website that we're going to say, okay, here's a building that we would like to buy, and if you are interested in this building and here's what's going on, subscribe into this fund, into this account, whatever it is, and when we raise the certain amount of money, we're going to go out and buy that asset. I mean, that's very, very difficult to do. People crowdfund for venture capital, things like that, because it doesn't go, that sort of business opportunity doesn't go away. To crowdfund a sizable piece of real estate, let's just say you wanted to buy a $300 million office building, or let's just say the $300 million office, you needed $150 million in equity. To go out and crowdfund that would be virtually impossible, because that's an institutional asset for institutional quality things. So the reason why the REIT structure makes sense as something you're buying for a REIT is that smaller investors can invest into the REIT and participate in a diversified REIT to own a $300 million building and do that. The crowdfunding is sort of on the come, and it's a little bit more difficult. It's different. I mean, crowdfunding is for a different purpose and not really for owning institutional quality real estate. But I think one of the things I want to always make sure is that people don't confuse crowdfunding with direct investing into something and bypassing the commission of a broker or something like that. So it's direct investing into a REIT is not crowdfunding.
Well, and I want to add on, there's also a difference in where a REIT falls versus a crowdfunding site under like SEC filing. Right? I mean, I think that's probably one of the biggest things is that the regulation under which each is filing under the like the regulation under the SEC that each is filing is different. All right, next question. Are there limitations on the types of REIT programs that can be invested in other than the regular prohibited persons rules? So no, you can invest in any type of REIT as long as, from our standpoint, the Entrust view on an investment inside a retirement account is if the IRS allows it, we're willing to hold it. Right, so that's where the prohibited transactions disqualified persons rule is. That's an IRS qualification. But in terms of type of asset, the only types of assets you're not allowed to invest in inside a retirement account are collectibles, life insurance, and S corporations. Right, so as long as the REIT isn't set up as an S corporation, your IRA can invest in it. And then he added on, for instance, is fundrise.com available? I don't know anything about Fundrise. Sounds like a crowdfunding site, but your IRA can invest through a crowdfunding site. So I'm going to say the answer is yes without looking specifically at what Fundrise is. Must you have a minimum amount in your self-directed IRA to invest in a non-traded REIT? The answer to that is no. You don't. There is no. The minimum amount required is going to be whatever the minimum amount is required by the REIT that you're going to invest in. They're the ones who determine the minimums, not the Entrust group. Do REITs typically pay out quarterly dividends or the like?
That depends on the REIT. I know in the case of the KBS REITs, it's on a monthly distribution basis. I know there's others that are quarterly, and then sometimes there's no distribution until, again, if it's a new construction, new project or something like that, and you're building something and there's no income coming from the property at that time, it could be a year before you get any distribution or payout. So, but in the case of yield-oriented REITs, I mean, that's typically the way they're set up. You're buying buildings that are leased up, or you're close to being leased up, where you're getting the income flow from the rents, and then you hopefully purchase the building and operate it properly to enhance the value of that, and that's your sort of two income flow, which is both from the rental income and then eventually from the sale price of the building at the end.
Okay, with a self-directed IRA, I can invest in my own condo as an individual and still earn around 8 to 10% return. It gives me control and 100% liquidity opportunity whenever I want it. In this context, what is the added value of REIT? So I'm gonna encourage you to reach out to John directly to talk about the pros and cons of a REIT versus investing directly in a property that is not through REIT. I will just add on that we are not encouraging you or trying to promote that one is better than the other. If you feel more comfortable investing directly in a condo for the reasons that you mentioned, then you should invest directly in the condo. You're allowed to invest in a condo directly in your IRA as long as it's one that you're not planning on living in. You're allowed to invest in REITs in your IRA. Again, we're just educating and and letting you know that these things are allowed to do. Like I said, if you want to talk, have John try and sell you on the idea of investing in a REIT, then please do call him or email him directly and have that conversation with him. Next question, do REITs bring in monthly income disbursements, or are dollars paid out when the asset is sold?
Yes. I mean, so again, depending on the REIT structure and what the underlying is, and we talked about that just before in the previous question. So yes, if there's income is distributed based on the cash flow coming from the underlying real estate, that could be monthly, quarterly, whatever, and then there's the distribution on the sales of the assets at the end of that, whenever that building or underlying apartment building or mall or whatever it is being sold, and then that's distributed out to shareholders.
Okay. We have one question left, and this is going to be for John, but I'm gonna just preface this for John. John, this is a yes or no question, that's all that I want you to answer with is yes or no. And Derek, if you want to follow up beyond his yes or no answer to this question, again, reach out to John directly. Question is, do you have to have a minimum net worth or a minimum amount in the SDR, self-directed IRA, to invest in a KBS REIT?
The answer is yes, you have to be an accredited investor. There's no limit, there's no minimum for what they can have in Entrust account or self-directed IRA. That's not, it's basically a net worth test, and they have to be an accredited investor to buy the KBS REIT.
Well, and you have a minimum amount, right? You have a minimum investment amount.
Oh yes, that's exactly right. Yeah.
Yep. So accredited investors, and they do have a minimum amount that they require, which I think most any private placement, private REIT is going to have a minimum dollar amount. And a lot of them are probably going to require you to be accredited investors, but not all of them. All right, John, we really appreciate you joining us, and everybody who sat in on it. We appreciate you, as always, coming to our webinars, and we'll have another one next month. So keep your eye out for that, and thanks for your time.
Thank you for having me.